For anybody who cares about their money, the phrase considerable time really matters. But when was the last time this Fed-induced phrase moved the markets or caused a big stir? The Wall Street Journal's John Hilsenrath making waves with his report that the Fed could finally drop the let's keep rates low for a considerable time phrasing in its policy statement next week. Listen.
It's a signal that for the first time really in 6 years, we're seeing a glimmer of interest rate increases on the horizon.
Okay, so we're warning everybody, but you could warn till the cows come home and the markets may freak out. How will the equity and bond markets react when rates eventually tighten, if the term considerable amount of time is jettisoned, and what's the best way for you, the investor, to be ready ahead of the Fed? Joining me now, Andy Richmond. He's SunTrust Private Wealth Management Director of Fixed Income, and Brian Peary, Hennessy Funds Portfolio Manager. Brian, to the equity side first, do you think that the Fed will lose the considerable time thing, and will that affect or freak out the markets?
You know, I think they'll probably go to a nod towards patience in the market. You know, I think that the markets really has to look forward, you know, a certain amount of time. So I think that they've already kind of factored in a mid-year move. Maybe it moves up a couple of months because of the better jobs report we had last week. But, you know, I think that the market is really kind of expecting it. You know, if they don't change now, it's going to be in March. That might be a little short. So I'd expect some kind of change in language this time around.
Andy, it's your job at SunTrust to anticipate how the markets, whether they be fixed income, equities, how they'll react. What is your best guess?
Well, I think we've seen the reaction already this year. It's going to be removed, whether it's in this meeting, December 17th, in January, as March has just alluded to. It's going to be removed because the Fed's probably going to start raising rates sometime next year. We think mid-year. But the markets, as they always do, have reacted ahead of that. And we've seen the yield curve flatten considerably. The spread between 2-year and 30-year have moved about 130 basis points in. The tightest it's been in about 5 years. So we've already seen the markets move on that, and we think they may move more, and the curve actually may flatten more if that comes
Okay,
down.
the curve flattens, ergo, what do people watching do with investments when it comes to fixed income?
Sure. I think, you know, depending on where you are on your risk tolerance, there's certain things you could do. One of them would be to make sure you're positioned for that curve flattening, which is not put all your money short term, which a lot of people have done. The 2-year note, even though rates are down, has gone from 36 basis points to over 70. So that actually rates have gone up. Everyone says rates have gone down this year. The short end's moved up. So you want to position to take advantage, and we've been slightly barbelled. Having some money shorter but also longer too has helped us this year.
Okay, that's Andy's idea. And when it comes to equities, Brian, what's your best suggestion as you anticipate what the Fed will do?
You know, in this juncture, I really kind of like the small cap and mid cap names. They tend to be less, you know, concentrated or multinational and won't be exposed to kind of a global slowing as much. You know, maybe kind of take a little bit of a lighter approach to companies that are in the telecom space or the utilities. You know, as much as we still like individual names there, a lot of times those get substituted for kind of an income stream. So maybe those get affected, but you know, I think that there's good companies that are relatively, you know, fairly valued and priced well in almost every sector.
Well, let me throw up your 3 picks: Pilgrim's Pride, JetBlue, and Mohawk Industries. And again, you're suggesting pick companies between 1 billion and 10 billion market cap, right?
Yeah, I think what we look for is, you know, increasing earnings on a year-over-year basis. You know, some momentum behind them. You know, in a fair, you know, reasonable valuation. We're looking kind of in the lower half of the market in terms of its valuation based on a price to sales. You know, so what we want to do is we want to find companies that are growing their bottom line in the benefit of the shareholder. You know, those are 3 companies that are certainly doing it in kind of a varied space. So I mean, I think that there are potential opportunities, you know, going forward. I think that the market's fairly priced right now, but you know, there's some stuff that we think has great growth potential going into 2015.
Well, that's definitely encouraging from the equity side. Andy, you and your team had a great call at the start of 2014 on munis. They have performed very well. Now what do you do? Do you like munis?
Yeah, real good question, Liz. Munis have had a fantastic year this year. We liked them coming into the year. We still like them now, but not nearly as much. Valuations have come down, but they still look attractive. If you're a New York resident, a California resident, you're paying state tax, city tax, you're paying the Obamacare tax, you're well over 50%. So on a 10-year muni right now, we can get a yield on a AA municipal bond still higher than the Treasury note right now, about 220. and we're getting tax advantage on that of 50%. So it still looks attractive to us, but where we were a little bit longer in the curve, we've moved into that 7 to 12-year range as opposed to going further than that.
Okay, we're going to put both Andy's and Brian's ideas on Facebook.com/Liz Claman. It's a pleasure to have you both. Andy Richmond of SunTrust, good to see you. And of course, Brian Peary, Hennessy Funds Portfolio Manager. Happy holidays. We are 5 minutes away from the close of the session. What is causing the volatility over 2 days? It's pretty significant. And look at the comeback. The comeback in the equity market. The Dow had been down more than 200 points. We're still lower, but it's a good move here, at least at 17,800. We have the answers for you, and we will hear from the actor much more from the movie actor interview, which is causing an international crisis and a lot of buzz in the process. James Franco, right here at Fox Business.